Hello, everyone. Thank you for joining us today for Assure's presentation. It is my pleasure to present for the first time on this platform, John Farlinger and Assure. And my pleasure to welcome you to the presentation. And I'm going to hand it over to John. The presentation is going to be about 20, 30 minutes, and then we'll open up to Q&A. Thanks for joining us. John, the stage is all yours.
Thank you, Neil. Good afternoon, everyone. My name is John Farlinger. I'm the Executive Chairman and CEO of Assure Holdings Corporation. We're a healthcare services company. We trade on the Toronto Venture Exchange under the symbol IOM and on the OTCQB under the symbol ARHH. And with that, I'm just going to jump right into our story, a bit of the history of the company, and an overview of our business model. Assure is what we believe is a best-in-class provider of outsourced intraoperative neuromonitoring or neurophysiological monitoring solutions. We're the only publicly traded pure-play intraoperative neuromonitoring company that we're aware of. And we recently complemented our core business with a launch of telehealth services at the end of the first quarter of 2021. We operate in 10 states. We did just under 10,000 procedures last year. We work with 191 surgeons in almost 130 hospitals. We employ over 80 revenue-generating technologists, and I'm happy to say we have a 97% retention rate with surgeons. We were the recipients of the Joint Commission Award in the United States, which recognizes the highest standards of care and excellence in the medical field. A quick chart shows you our growth over the last 4 years. When we went public, we did almost 1,644 procedures. We did almost that many last month. We've had consistent growth over 18, 19, and 20, with last year growing from 6,400 procedures to just under 10,000 in 2020. We were affected by COVID because of the downward pressure on surgical procedures, and certainly ones that were discretionary and not urgent. And this year, we're forecasting to do over 17,000 procedures before the end of the year. Corporately, we have really 4 key objectives. And our model, and I'll get to show you how we make money in a second, but we're focused really around increasing our scale and size. And we expect to grow by over 70% this year. We grow by a combination of organic growth and M&A. We've done 3 recent M&A transactions over the last 15 months, and we are focused on building out our own telehealth neurologist telemedicine platform. And to that end, we started in March. We've now had our second neurologist start, and we have 2 more who have been hired, who will start at the end of the summer and into the fall. We are also seeking contracts with hospital groups across the United States. A big part of what we do in building our platform is really focused around getting contracts with insurance companies and being really good at collecting cash and facilitating revenue cycle management. To that end, we had some challenges a few years ago in getting paid. Our accounts receivable numbers were very high, and that was not ununique to the rest of the industry. Nearly everyone in this industry, and in healthcare in general, there's a lot of situations where companies don't have contracts with the insurance companies. We are focused on contracting and partnering with them, and we're focused on analytics, data, and automation. By the end of this year, we expect to have over 50% of our volume in contractual terms with the insurance companies. And to a degree, we're a maverick in the industry. No one else is doing that. And as of right now, we have just under 30%. That is linked to better cash collections, generating higher levels of cash flow. And I'm very proud of the progress we've made over the last 2 years, where we now employ almost 27 people working on automation, billing, collections. Last year, we improved our cash flow by over 50%, and we are expecting significant improvements yet again this year. It is a core competency and a differentiator for us going forward. And lastly, in terms of objectives, it's clinical leadership. We want to continue to leverage our competitive advantage in quality of service and our standing in the intraoperative neuromonitoring industry. We believe we're becoming a leader in education, training, research. We've set up our own education department. We hired an academic who was taught at Harvard, the University of Chicago. He heads up our training and education program, where we're hiring students right out of known universities like the University of Connecticut, the University of Michigan, and putting them through our way of thinking. We recently filed an S1 registration statement. It was deemed effective in February. Since then, we've done 2 acquisitions and a debt transaction with an institutional group from Toronto. And we are in the process of filing an application and responding to comments back from NASDAQ as we pursue a NASDAQ listing later this year. Some of you may not be familiar with intraoperative neuromonitoring. Quite simply, it's the use of electrophysiological methods, usually referred to as EEG and EMG, to observe the functional integrity of neural structures during surgery. These are complex surgeries. We are working with surgeons on highly invasive surgeries, neurosurgeries, spine and back surgeries, open heart vascular surgeries, etc. We're providing feedback to the surgeon during that surgery. So essentially, we have a technologist who is our employee working in the operating room, and we have a neurologist who is working remotely, and they're working as a team with the surgeon and the hospital. This is now the recommended solution of choice by the American Society of Anesthesiologists, and it's now part of medical school curriculums in the United States. We are going through a continual advancement of this business into other verticals. It started really in orthopedic and spine, but we are now pursuing verticals in ENT, vascular, and we're deeply involved in neurosurgeries going forward. 1.4 million surgeries took place last year using intraoperative neuromonitoring, and we expect that growth to continue over the next decade. How it works and how we get paid, a simple diagram here I think will show you how our business operates and the flow of money. It starts really in the operating room, and in blue you see the operating room environment with a surgeon who's working on a patient who's face down, a typical spine or lower back surgery. There's typically a nursing team and anesthesiologist all working in concert. In the operating room is our technologist who's looking at data on a piece of equipment that looks like a computer screen, and they're looking at up to 32 different modalities. They're sharing that data with a neurologist who's working off-site. The neurologist, the technologist, and the surgeon are all communicating during a complicated procedure. And they're talking about the data. The neurologist is guiding the surgeon to make sure that things like the effects of anesthetic, the effect of the scalpel in close proximity to a neural gateway, and a host of other modalities are being monitored carefully so that a deficit or damage is not done to a patient during a complicated surgery. In our model, we have a couple of revenue streams. For our technologists, we're billing directly to the insurance companies or the hospitals for the provision of these services. We're billing in addition to what the surgeon, the anesthesiologist, and the rest of the operating team are billing. We bill, we keep that money. Separately, we have multiple partnerships with our surgeons where we bill and we collect for the neurologist. And typically, we've been using contracted neurologists in the past. We've been using contracted telehealth companies to do it. We decided that we will do this ourselves. And we're in the middle of really ramping that business up. And we see being significant players in servicing our own business, which will be in excess of 17,000 procedures this year, and growing and continuing to grow. The advantage of bringing it in-house is that it creates additional profit and margin for us. Where if we outsource it, we're paying anywhere from $600 to $800 on a variable cost basis. We're losing half of that margin. We believe we can make a 50% margin plus out of the gate, and we see generating a significant amount of business going forward. For the neurologist services, we're doing all the work. We're billing, we're collecting, we're hiring, we're recruiting for that now, and we're in the middle of ramping that up. And we expect to not only be doing intraoperative neuromonitoring, but EEG and other forms of services going forward. We're pretty excited about this, and it'll be a key part of our business going forward. Our model in the US, I know most of you are from Canada. It's pretty complicated. in a healthcare environment. In our ecosystem, as we look at it, there are really four key groups that we're working with: surgeons, hospitals, insurance companies, and the patients themselves. Why we've been successful at growing our business when many of our competitors are struggling to maintain existing market share is it's all about quality of service. It's all about the relationships we have and how we manage them. Surgeons are critical. We were quick to realize that many of these surgeons were unhappy with staffing companies, hospitals, and having technologists parachuted into the OR without visibility into their training, their background, and there was a lack of continuity. Our model is focused on partnering with the surgeon, giving them the same technologist on every service, and making sure that we have the highest caliber of technologists going into the operating room. We also offer the surgeons a revenue share, where we are displacing other companies who are providing telehealth services and allowing us to do it with a rev share for surgeons. In some cases, these are six-figure amounts of money that surgeons are, many dozens of them are making in working with us. The hospitals are key members of the ecosystem. They're focused on patient care and liability. And with COVID and the challenges that's created, they're all focused on costs and reducing costs, particularly the smaller and regional hospitals. And what they're trying to do are cut technologist costs and even neurologist costs. So this is really playing into our hand in terms of offering a menu of services which can be done remotely or outsourced to us. And we see a significant amount of growth developing there as we are pursuing multiple hospital relationships now. And we've been successful in converting a number of small hospitals into our model now. The insurance companies are critical. They're the people that pay us. And when the company started, there were challenges in not really understanding the dynamic of the ecosystem. And most of our competitors are still battling that same battle. They're out of network. They don't have contracts with the payors, and they are simply billing and hoping to get paid 6 to 9, 12 months later. We went the other route. We feel the key to our existence and our value is for the insurance companies to understand our value, to give them data back, and to make sure that they understand how we fit the ecosystem and then getting a fair rate of return. As we go in network and partner with them, we're typically going to be paid in 30 to 45 days, thus turning cash over much more quickly and developing a competitive advantage. And I should point out, part of my management team came from a company where they did this over a decade. Paul Webster, who heads up the contracting for us, worked with a company called Air Methods. They became the largest air ambulatory service in the United States through M&A and growth. He helped grow that business from a $100 million market cap to a $2.3 billion exit. A big part of their success was predicated on going out and partnering with the insurance companies and making them aware of the value and the value we're creating. Patients are critical. Obviously, the focus here is on ensuring quality of life, both pre, during, and after complex surgeries. And so we're evangelizing to them the value of intraoperative neuromonitoring, the role we play. We're helping them understand the billing process post-surgery. And we've also built our own patient advocate team that works with patients both pre and after surgery. It works out pretty well. I think this ecosystem is really starting to work for us as we've made significant progress over the last 12 to 18 months. And I think we're going to have significant progress again this year and going forward. Talked a little bit about the trends in the industry. This is clearly a growth sector. The outsourced market is about 880 million with about a 10.1% CAGR. It'll grow to about 1.1 billion by 2022. The insourced market, which is really the hospitals, is about 850 million, growing at roughly the same rate. It's roughly a $2 billion vertical. Right now, we're 1% of the market, and we have aggressive plans through M&A and organic growth to pick up a meaningful part of this vertical. I think if you look at reasons why we've grown and why the market's growing, again, the tailwinds are working in our favor. You've got an aging population. There's an increasing prevalence of chronic disorders. And as we look at the market, we see a huge opportunity to be a consolidator here. We spent most of the last 18 months building a platform which was focused on quality of service, revenue cycle management, data, analytics, and building a telehealth platform. These are differentiators for us as we look at most of the competitive landscape, which I'll just get to in a second. And here you see it. As we look at the market, we're competing with other interoperative neuromonitoring companies who are similar in size or smaller to us, the hospitals. And there are two large players, NuVasive and Specialty Care. NuVasive, multi-billion-dollar medical services company, devices, bundled services in the hospital. They do this as a small portion of their business. Specialty Care is a PE-backed company. About 35% of their business is from intraoperative neuromonitoring. They started as a blood perfusion company. And then there's us in the top left. Both NuVasive and Specialty Care do about 120,000 procedures, a little less than 10% of the market. We were about 10,000 last year. We'll grow this year to about 17,000. Two of the larger competitors ahead of us are MedSurant and National. Both are experiencing very little growth. And then you've got literally dozens and dozens of competitors that are doing over 500,000 procedures annually. Hospitals doing about 600,000. So we're on a path to be a consolidator and to continue to grow aggressively going forward. And we think building and putting the money in infrastructure will help us and serve us well going forward. Quick map of where we are in the United States. Everywhere in green is where we currently operate. Started in Colorado. We jumped into Utah, Texas, Louisiana. We're now in Michigan, Pennsylvania, South Carolina. And just recently, we opened up Arizona. And through an acquisition that we made just over a month ago, I guess almost 2 months now, we were able to get market share in Kansas and Missouri. And we're exploring and looking to grow in both of those markets. Our growth over the last few years has been primarily organic, but we are seeing a number of our competitors who are undercapitalized, lacking the management skills to grow their businesses, and lacking really the expertise to go and raise additional capital. I think other things that we're doing to exploit the market, we've set up a distributor platform where we are going out and harnessing spine distributors in the United States who are working with dozens and dozens of doctors each, and they are bringing their surgeons onto our platform. And I think right now we have over 10 contracts that we sign with distributors. We think that will be a significant source of growth. We're very unique in setting up that platform through an aggressive email outreach campaign that we've got. We're doing the same thing with hospitals, and we're aggressively going after facilities in a manner to induce them to outsource to us over the long term. Targeted states here, just quickly on the targeted states, we are looking at Minnesota, Nebraska, Alabama, Virginia, and New Jersey in the short term. And we're looking at opportunities to expand into those markets in the very near term. Again, this is a reiteration of what you saw on slide 1. It shows you our progressive growth from really year to year. I think as we uplist, and hopefully uplist this year, we'll have a currency that will allow us to continue to use a mix of organic growth and M&A going forward. I think there'll be value opportunities moving forward as we continue to grow our business. Again, we're forecasting over 17,000 procedures. I think we released numbers last month that indicated we're roughly at about a 17,000 procedure run rate right now. And so we're optimistic that we'll have a very strong second half of the year. And in our business, there is a cyclical nature. The second half of the year is always much stronger than the first half, as patients try to leverage deductibles. And in many cases, there are significant deductibles. And so as patients use those up, there was a predisposition to really getting as much surgery work done in the year where they don't have deductibles. Typically, our fourth quarter is incredibly busy with Decembers, usually resulting in our techs not taking a day off. And that's how busy it gets. So we're pretty optimistic. We're going to have a strong second half. Time will tell, but we're feeling pretty good right now. One of the issues that I talked about briefly earlier was really the telemedicine opportunity and really getting into the neurologist business. I believe this is a critical foundation for us going forward in that it allows us to get additional revenue off of each procedure rather than giving up that margin to contracting companies. And they're taking roughly a 50% or more margin. Many of our larger competitors like NuVasive and Specialty Care get into this business early. I know Specialty Care probably employs over 100. We're getting into that business so we can compete with Specialty Care and NuVasive on any level. Why this is critical is that any new acquisition, any new state now generates more margin as we provide telemedicine services. Out of the gate, we'll simply provide this to our own business. 17,000 procedures is a meaningful amount of business. I see us being able to do it for our competitors who are not going to be able to afford to do this. I see us offering these same services to hospitals, and I see us offering a menu of services to the hospitals. We're selling to them now. We've got 5 dedicated salespeople and a channel program set up where we can sell more into the hospital environment. And embedded in this, a key part of our growth is data and analytics and using information here going forward, where I think very quickly we're going to become a leader in doing that. We just recently hired a very strong CIO who would work with Microsoft and in Silicon Valley. His strength is data warehousing, analytics, automation, and we're knee deep in really taking our business to the next level and using data. Recently, I mentioned we acquired our third company a few months ago, Century Neuromonitoring, a competitor of ours in Texas, Kansas, and Missouri. They were larger than we were 18 months ago. They performed 5,500 procedures last year. That acquisition improved our volume by about 50%. They generated about $5 million of cash receipts. They had a couple of key issues. They weren't able to raise capital, and they were outsourcing their RCM function or their billing function. They went through 3 vendors over a period of just over 15 months. Not a good position to be in. We acquired that business for $3.5 million, $1.2 million in cash over time, and $2.3 million in Assure stock. We picked up all of their accounts receivable. There was very little debt, and I think we're going to collect a meaningful amount of that accounts receivable going forward. There are other opportunities like this out there, and why we wanted this deal, we like their team. It allows us to become a significant player in Texas, and really, with additional volume, it allows us to negotiate with greater strength with the insurance companies there. So again, it's all about strength in volume, revenue cycle management, and improving cash flow. And we're already hitting our numbers here as we look to make this business very quickly cash flow positive and getting a very significant ROI on this acquisition. Factors supporting our growth. If you listen to one of our earnings calls, I'm a broken record. It's all about increasing case counts. It's all about collecting money. It's all about increasing the average revenue per procedure. We had challenges when the company started around revenue accrual rates and adjustments, where there were challenges because in an out-of-network model, you don't know what to really accrue. You're accruing the average of what you collect. And those numbers were changing quickly. In our model going forward, as we go to 50% of our volume in network, the rates will be simple. They're what you got contractually with the insurance companies. So, and we're also going through and reconciling all this on a monthly basis. We're reducing our write-downs, and a critical part of this is in-network contracting. I think right now, as we look at this going forward, we brought nearly everything in-house. We use third-party vendors only for old accounts receivable that we haven't been able to collect. We went from using third-party vendors where we were getting paper reports the following month with no visibility into our data. And this is how most of our competitors operate now, into having deep analytics, exchanging data, using automated, portal-to-portal data, sharing medical data, following up on appeals were not paid, getting cash now on an ACH basis. We've moved from a paper environment to a completely automated environment. The next iteration of our business is going deep in analytics and data and being able to go out and evangelize our services leveraging that data, learning more about which procedures pay higher amounts, which insurance companies pay higher amounts on those procedures, which states pay better. And we built a fairly comprehensive set of data around where we want to expand, why we want to expand there, and it's driving our growth going forward. And I think right now, I feel pretty good that we can compete with anybody in the United States, head on head. Balance sheet, we recently announced an $11 million facility with Centurion Financial Trust out of Toronto. We've been actually in conversation with them over the last year. Preceding that was a $10.5 million private placement by special sit funds out of New York and Manchester, two well-known institutional investors in the United States who wanted to invest pre and uplisting. We're the beneficiaries of $1.7 million in PPP loans under the CARES Act, which are non-repayable if they're used for payroll, which we did. And we've still got the lingering effects of about $3.4 million in non-brokered convertible notes that are convertible at $1.40. Some of those are starting to convert now as we start to trade above the 140 US number. We went from losing money from a cash flow standpoint to being break even last year. I think as we look ahead this year, this is all about growth. We're taking excess profits and we're all in on growth, picking up market share, growing our telehealth business, and growing it quickly. The balance sheet, 56 million shares outstanding, 19 million, almost 20 million warrants at a price of about 78 cents. Stock options just over 5.1 million. Fully diluted around 86 million shares. At the end of March, we were sitting with 4.1 million in cash, 15 million of accounts receivable, other assets of about 14 million. Most of our debt was trade debt with some bank debt of about 8.1 million. We've since paid the bank debt off with a facility from Centurion, and we've recapitalized our balance sheet and paid off the bank debt. And we're probably sitting with 5 to 6 million in cash right now in treasury. Going forward, we're not looking to raise money right now as we uplist. The only reason for any further equity raises would be around a meaningful and sizable acquisition going forward. Management team, myself, I came on board as chairman and CEO. I was independent director, was asked by the board to get more active in, late 2018, agreed to be an interim CEO for 9 months. That was almost 3 years ago. But I'm very proud of the people we brought on. In particular, if I start at the bottom right, Sean Blosser, who heads up our revenue cycle team, was able to poach him from a PE-backed company called Option Care Health. He was managing $800 million of revenue, a third of it out of network. He's built our team from the ground up. Stephanie Krause, more than 10 years of interoperative neuromonitoring. She's an interoperative neuromonitoring technologist herself. She manages over 80 technologists in the field. Paul Webster, who I mentioned earlier, 20 years in out-of-network billing, including being a VP of payer strategy at Air Methods, the largest air ambulatory service in the United States. Strong background in healthcare, regulatory matters, negotiating in network contracts and M&A. John Price recently joined us after been a part of a decade with Ernst & Young, the latter part of it in Silicon Valley. He's done 2 S1 filings and been CFO of 2 NASDAQ-listed companies. Alex Rasmussen came to us from a banking background. He oversees business operations, onboarding doctors, hospitals, etc. And Preston Parsons was the founder, former quarterback in the NFL. It was his idea to really build this business and seeing an opportunity in the market. Quick snapshot of our board. Myself and Preston are 2 of the management incumbents. Dr. Chris Romana, well-known neurosurgeon in Florida. He was doing over 600 procedures a year before he retired in his early 50s. He's a board member of the Tallahassee Memorial Hospital. Complementing him are Martin Virian, CPA, an acquaintance of mine from Vancouver, who is also a chartered business valuator, a career banker as well. Stephen Summer, former CEO of the Colorado Hospital Association, really a career healthcare executive. And then John Flood, an acquaintance of mine who recently joined, who spent 35 years in capital markets in the United States, most recently as co-founder and chairman of the Craig-Hallum Capital Group in Minneapolis, a well-known investment bank and research company in the United States. So a mix of, we feel a good mix of experience and backgrounds, and we're excited about the opportunity to move the business forward and potentially uplist on the NASDAQ. Thank you.
Well, wonderful presentation, John. Thank you very much. I'm going to just put it back to a couple slides here. If anybody has questions, now is the time to ask. We don't have too many people on this call as it's our first one, but the replay will be going out to everyone. So let's have a look at the question tab, see if there's any questions. That was quite a lot of information to absorb. So I'm sure people are just looking at their notes, and hopefully a couple questions will come aboard here.
Neil, I see a few questions. The first one, John, is how do you see the company 1 to 3 years from now?
Well, internally, we're ramping up and acting as if we're doing 50,000 procedures now. That's the mindset of management. I think we've told the market we'll grow by 70 to 80% this year. I think we can continue that next year. And certainly, if we're active in the M&A front, I don't see any reason why we couldn't continue 70 to 80% growth. And we've been doing that over the last 3 years as we've ramped up. Obviously, it becomes a bit more challenging as you go to scale. I think the other opportunity, though, which is not quite as evident, the opportunity in telehealth is significant. And I think it's very meaningful for us to get into that vertical. I think in our existing business, margins, you'll be trying to protect margins as you scale and with competitive pressure. On the telehealth side, I could see not only margins being maintained, but improved on as you go to scale. And I think we're very excited about that. And I see I'm very optimistic we're going to have a very strong second half of the year. And we see lots of opportunity to not only grow organically, but also we see additional M&A opportunities out there where we can acquire additional competitors at very attractive rates. And, just for an example, we acquired a company last year in Texas that we paid $7.7 million for. That was 2.7 times cash flow. And that was a well-run company where they wanted to exit. I think for distress assets, there are a number that we're looking at now. They create an even bigger opportunity for us. And I think as we have a currency here that develops more value, that'll be more attractive for us going forward and growing the company, hopefully at an accelerated rate.
Thank you, John. The next question is, what type of financial metrics should investors be monitoring as the company moves forward?
Key things for us are the things that we're looking closely at are average revenue per procedure numbers, number of procedures. That drives both a technologist and a neurologist bill, and then margins. I'm on the record as saying we are looking to reinvest everything in growth this year. So a key driver here will be growth numbers, revenue numbers, and our ability to collect cash. Cash is critical. And that drives our business and really drives the healthcare sector in the United States.
Terrific. Another question is, when you're evaluating potential growth opportunities between organic, M&A, the telehealth neurology services, how are you able to evaluate them one against the other?
Let me break down, I guess, and this is something we do all the time. We're looking at organic growth versus M&A. And it usually comes down to a cost of acquisition. If we're investing in new markets, we're looking at and we've got pretty much all this modeled out. Certainly in an M&A environment, we're looking at a cost of acquisition by acquisition. And then we're looking at investing in new markets and what we think the cost of bringing on new business will be. Because there's a cost of going into every new state. There's legal work, contractual agreements. It typically takes 90 to 150 days to get ramped up in a new state. An M&A deal is very straightforward. What do we think the cost of acquisition will be? for a procedure, number of procedures. On the telehealth side, it's a little bit different in that we're looking at getting into a new vertical, which will add value to our existing business, with a vertical which will have higher multiples potentially than our existing core business. So I think, and we're also looking at potential acquisition opportunities in that space. So it's pretty straightforward on organic versus M&A. It's cost of acquisition. On the telehealth side, it's a bit more complicated because an acquisition might be able to accelerate our own growth by putting our business onto an acquisition target, or it may be that we feel we can accelerate our own business without doing that. And as I said, we're knee deep in ramping up now.
Thank you, John. And one final question is, what additional investments in infrastructure are needed as you scale to growth later this year?
Good question. Last year, we spent a six-figure amount on automating the accounting area, the RCM area, and moving everything into a position where we could use analytics and data and ultimately data warehousing. And so most of our push now will be on improving the ability to pull data out of our environment to run a lot more in the way of analytics, using AI, using bots, to be able to get more meaningful information, particularly on the billing and on the billing data and other relevant health data, and then integrate that into other types of reporting that we can do. I think we're pretty far along on the reporting side. The upside, the huge upside for us is on the analytics and the AI as it relates to looking at payor information, the profitability of states, the profitability of certain types of procedures, the ability for us to reduce deficits in the operating room, and taking that data and giving it back to the insurance companies. One of the reasons we've been successful is we take the insurance company's own data and we give it back to them. We're over 1,000, 2,000 procedures. We'll show the effect of our people in the OR and what would have happened if we weren't there. And then it comes down to a cost of ownership. And what we're finding is our data is pretty compelling, which is then driving us to a larger number of in-network agreements.
Terrific. Well, thank you so much, John, for answering these questions. Neil, do you have anything further before we sign off?
Yeah, we got one question from Sean just under the chat tab. It's not under the, it's just over the top right. You just got to flip over to the chat tab, and he's got a question right there for you.
Neil, do you mind just reading it off then?
You bet. Yeah, Sean asks, it's not all about the financial metrics. I'm sure there are hundreds of life-saved success stories using Assure's interoperative neuromonitoring, but are there any that are exceptionally memorable? And then he follows up with, he's close friends with several surgeons in the US, and I would love to introduce them ASAP. I am positive they will pick up some stock as well. So a couple.
Yeah, great questions. So on the life-saving stuff, it happens regularly where we're involved in life-saving opportunities. Just recently, our best people are put on the toughest cases. Some of the toughest cases are scoliosis cases, where you've got children who are being effectively deformed through disease. And recently, Stephanie, our VP of who oversees all of our techs, I think did a 9-hour procedure, which was successful. And it was not a high probability case, but it was the result of very complicated and diligent surgery work, really leading to an outcome where you saved this 9-year-old child's essentially way of life and quality of life going forward. In our case, we recently made a presentation to one of the payors in Louisiana, and there was a video done by one of our surgeons where he had to do a complicated cranial surgery, essentially putting a drill into the back of a child's head to remove a tumor. That tumor could not have been removed if he didn't have intraoperative neuromonitoring, because there are literally hundreds of neural gateways going through the skull. And he went on record and said, listen, this was a tremendous service. I could not have done this if the insurance company was not paying for these services. Wouldn't have taken the risk professionally to do it. But because of interoperative neuromonitoring, I was able to manage it, gauge it, and it led to a successful outcome. And yeah, and if anybody wants that video, I can certainly dig it up. But we're doing this pretty much every month. You know, probably about 4% of the cases in most states, we're doing something in. And it can be as simple as moving a patient around, adjusting their position on the table, looking at the effect of anesthetic, measuring the effect of neural gateways and how, and neural activity. But that's the business we're in. It's actually improving quality of life. And there's also a new release coming out, a press release about something we did recently. I can't really talk about it until it's out there, but it's pretty compelling as well. And this is why we're in the business here. It's to affect people's lives and hopefully improve them.
What a wonderful story. That's fantastic. Thank you very much. And Sean just mentioned that he loved the answer.
Okay.
I think that is it for the questions. Like I mentioned in the chat area, you can always reach out to us after the replay and book a follow-up meeting. And we'll be in touch with everybody with the replay links. And yeah, have a wonderful remaining year, everyone. And we'll speak to you soon.
Thanks,
John. Thank you, John.
everyone.
Thank you very much, everyone. Goodbye.